Hi, I'm Joseph Kim. In this week's video insight, I will be discussing the potential issues of using earnings multiples for valuing companies with finite life assets, especially as they approach the end of their useful life. During the recent June quarter production reporting season, a number of mining companies recorded steep share price falls, one of which was Sandfire Resources, a mid-cap copper producer. With the share price of its direct peers being relatively stable, it appeared the sell-off was due to a stock-specific issue rather than a drop in the copper price. The company, however, provided 2019 production guidance similar to its 2018 performance, suggesting a stable operating outlook. So what prompted the selling? Analysts pointed to Sandfire's American subsidiary conducting a rights issue, as well as a delay in developing a high-grade section of the ore body as potential catalysts. But in this case, the fall must be put into context relative to its share price at the time and what it was implying for future earnings. Prior to the release of the June quarter report, Sandfire's $9 share price implied an expected 2019 price-earnings ratio of 9 times and an enterprise value to EBITDA multiple of 3.7 times. While these headline multiples appear very cheap for a quality copper asset, any earnings multiples should be referenced to the remaining life of its assets when assessing its investment merits. In the case of Sandfire, the company's resources and reserve statement suggests the mine life of less than 4 years without exploration success. Within this context, a price-to-earnings ratio of 9 times appears high when its earnings may not be repeated more than 4 years into the future. A more accurate reference check may be the EBITDA multiple, as EBITDA provides a better representation of a mining asset's actual cash flow. Sandfire's prior multiple of 3.7 times compared favorably to its remaining mine life of about 4 years. However, what the EBITDA fails to capture is the cash outflows associated with tax, sustaining capital, and any unfunded remediation liabilities. It is important to account for an estimate of these items as they may have a material impact in the remaining cash available for shareholders at the end of its useful life. Thanks for listening, and don't forget to follow us on Facebook and Twitter.